In this short video, we are going to look at Fitch's approach to assign ratings to senior debt and deposits. Senior unsecured debt ratings capture the overall level of credit risk by assessing both the level of default or non-performance risk and of potential recoveries in case of default. In jurisdictions without developed resolution regimes, the anchor is typically the long-term issuer default rating, or IDR. In jurisdictions with developed resolution regimes, the anchor is typically the viability rating, or VR, and may also be the shareholder support rating in the case of subsidiaries. The senior unsecured debt ratings can be equalized or notched up or down from the anchor. Fitch's baseline approach is to rate senior obligations, senior unsecured debt and deposits of banks and bank holding companies, or BHCs, in line with the long-term IDR. This reflects the fact that default on senior obligations equates to the default of the bank, or BHC, and usually average expected recoveries upon default. However, we may depart from this baseline approach in jurisdictions with developed resolution regimes, or when rating obligations of entities at low rating levels, a long-term IDR at B category or below. The table here shows typical notching for a bank holding company in jurisdictions with a developed resolution regime. In these jurisdictions, the anchor would typically be the VR. In a bank holding company structure, the resolution debt buffer consists of holding company senior debt available to be or already downstreamed to the operating company and capital instruments issued at group level. The notching for individual obligations depends on the size of the resolution buffer, and for deposits, whether there is depositor preference in the jurisdiction. In jurisdictions with depositor preference, for banks subject to a regulatory resolution buffer requirement, deposits are typically notched up twice above the VR anchor. If there is no buffer requirement, then deposits in these jurisdictions are notched up once. In jurisdictions without depositor preference, deposits are equalized with the anchor in the absence of a resolution buffer requirement. If there is a resolution buffer, then deposits can be notched upwards once for a buffer below 10% risk-weighted assets, and twice if the buffer meets 10%. Senior unsecured debt issued by the operating bank is typically notched up once above the VR anchor if the resolution buffer is 10% or higher, and twice if the resolution buffer meets 15%. Senior resolution debt issued by the bank holding company is typically notched once below the VR, but may be equalized if there is a large buffer or if other conditions apply. The table here shows typical notching for a bank-only structure in jurisdictions with a developed resolution regime. The notching approach is very similar to the bank holding company case on the previous slide. For bank-only structures, we consider the resolution debt buffer to comprise senior resolution debt, also sometimes referred to as senior non-preferred debt, and junior debt, comprising additional Tier 1 and Tier 2 instruments. In jurisdictions with depositor preference, deposits are typically notched up twice above the VR anchor for banks subject to a resolution buffer requirement, and once if there is no buffer requirement. In jurisdictions without depositor preference, deposits are equalized with the anchor in the absence of a resolution buffer requirement. If there is a resolution buffer, then deposits can be notched upwards once for a buffer below 10% risk-weighted assets, and twice if the buffer meets 10%. Senior unsecured debt issued by the operating bank is typically notched up once above the VR anchor if the resolution buffer is 10% or higher, and twice if the resolution buffer meets 15%. Senior resolution debt is typically notched once below the VR, but may be equalized if there is a large buffer or if other conditions apply. For more on the fundamentals of Fitch's bank rating criteria, view the other videos in the series.